Thank you very much for inviting me to discuss this paper. As you can see from my color choice, that I appreciate that we can be here in Chile. The fact that the paper is very fast-moving is reflected in the fact that the title is not what you see on the program. So this is Elisa's US-based paper that I'm mainly going to be discussing. There's a very interesting calibration exercise to the Chilean economy, which she talked about, which I'm not going to talk about very much. Okay, excellent. So let me motivate this paper by pointing you to the fact that we live in very unequal times, right? In many countries in the world, we've seen strong increases in income and wealth inequality. We've just gone through a very unequal recovery from the COVID pandemic. We're living through the energy crisis that Adrian talked about. And then Valerie already mentioned, we're starting to do a green transformation. And all of those are going to have winners and losers in the economy. So I think a very natural question then to ask is, does monetary policy, for example, the current monetary tightening cycle, exacerbate those inequalities or mitigate them, right? And so inherently, we want to understand the heterogeneous effects of monetary policy across industries and or across workers. And this is exactly what Elisa's paper is about. Now, there are many dimensions of heterogeneity that you can think of here that can drive these heterogeneous effects. So just give you a few simple examples. Clearly, durable goods producers and investment goods producers are going to be differentially affected by monetary policy from non-durable goods producers, just because durables and investment tend to be more sensitive to monetary policy. What about balance sheets? Clearly, if you are a borrower and the central bank eases rates, probably you're going to be better off than somebody who has a lot of money in a deposit account. And that's where a lot of the Hank models are going to be, that's a dimension a lot of Hank models are going to be thinking about. In an open economy like Chile, you might also think about exchange rate exposure, right? That maybe if you export and the exchange rate depreciates, that's great for you. But if you're an importer, then you might lose out more. And so the main source of heterogeneity that Elisa focuses on is heterogeneity in price or wage rigidity across sectors. There's also a part of her paper that is more about supply elasticities. It's not really factored into the calibration yet. That's why I'm not going to talk that much about it, but I'm going to focus more on the source of heterogeneity. And the main finding there is that this channel alone can be very powerful. The fact that some sectors are going to have stickier prices is going to drive a lot of heterogeneity. Okay, so what's the roadmap going to be like? I'm going to review the current version of the paper as I received it, and then I'm going to offer 3 comments, but take all of it with a grain of salt because the paper is still evolving. All right, so the aspiration of this paper and of this model, in my reading, is to make Buckeye useful for monetary policy analysis. So how do we get there? Essentially what we do is we take the most complicated Buckeye paper and make it even more complicated, okay? So what do I mean by that? We take their HAIO paper. You might have not looked at that paper yet. It's one of their 10 papers. That paper is the most complicated. What does it have? It has many distinct consumers. It has many distinct producers, and it allows for many fixed factors. And then you link them in all sorts of complicated ways. We allow for input-output linkages among producers. We allow for heterogeneous consumption baskets across consumers, and we allow for rich ownership patterns, that telling you which consumers own which factors. So we take this model, and then we make it more complicated. How do we make it more complicated? Well, we need nominal rigidities to be there, right? Otherwise, we can't really talk about monetary policy. So Elisa adds general price and wage rigidities. We're going to think about wage rigidities in the same way as Elisa is by just adding sort of a union sector that sets wages. We're going to add flexible labor supply and something, and I'm going to talk about that a bit more, something that resembles investment. We're going to go fully dynamic, infinite horizon economy, and we're going to add a monetary policy rule. For now, as Elisa was saying, this is a money supply rule, but she has ambitions also to have a Taylor rule in this economy. So let me give you an example of how complicated things get once you do these things, okay? You have a few equations, looks innocuous, and then you keep going, and then it becomes even more complicated, and proposition 1 is already flies way past you. So compared to this, the Buckeye Fire paper is like a light afternoon read. So this is tough stuff, and I'm kind of impressed how Elisa, was flying through a presentation in a way that was very understandable and did not have to go into all these details here. So I'm going to focus on a more tractable model, which I think is related to one of the special cases that Elisa mentioned in her presentation too, that I think we can actually learn more from than the paper currently exploits. So what is this more tractable model? Okay, the beauty of a discussant is I can just make these assumptions and tell you what we learn, and then Elisa has to think about what to do with that. So I'm going to assume preferences and production functions to be Cobb-Douglas. I'm going to assume that households consume all the same bundle. It didn't do a lot in her calibration, so I'm just going to assume that they all consume the same bundle. I'm going to assume complete markets. So in some sense, all the households are part of a big family. They share income, and then they allocate consumption jointly. And then the key assumption I'm going to make here is I'm going to assume an infinite Frisch elasticity of labor supply. And anyone who has worked with pricing models kind of knows that that's kind of a nice trick to get a lot of tractability. Okay, I'm going to tell you why that is. So just to put some math here, family of households maximizes log household consumption plus log real monetary balances of the entire family. And then there's linear disutility from supplying labor to, as part of the different factors here. And that's where the infinite Frisch comes in. We have all the different sectors. They have Cobb-Douglas production function in labor and in intermediate inputs. And we're going to think of each sector sort of as being, comprised of a continuum of firms, and each firm has sort of a random probability delta I of adjusting the price. So that's the entire economy. Okay, so what happens in that economy? So let's say we feed in a small, 1% increase in money supply. The way we've rigged it, that immediately means we increase nominal spending by 1%. That's sort of the log in the utility. And the infinite Frisch gives us that wages in all sectors also move by 1%, which is really convenient, right? Because that pins down nominal wage inflation in all sectors. Now, if prices were flexible, that 1% increase in wages would just translate sort of down the supply chain into 1% increases in all prices and no quantity changes. That's a clean benchmark. What happens if prices are not flexible? What happens if there's a gap between 1 and delta I? In that case, you can actually derive a very neat formula, which I did not find in Elisa's papers. I was proud that I could come up with this formula. So what does it say? It says that the percent change in employment of factor F is related to some sort of, generalized version of a sales to income ratio. That's something that shows up in some of these input-output rigidity models, and obviously clearly related to 1 minus delta I. So what this entire sum tells you is that employment changes more for the factors that are supplied to sort of a production chain, a supply chain, that has, on average, higher rigidities, higher price rigidities. And the sales to income weights are exactly the way to weight these different price rigidities. So that's kind of a neat result. Let me just illustrate it, what it means. I also have my own pictures. So we have the primary factors up on the top, the different types of, let's say, workers that work in different industries, and then they supply to, supply chains each. So what happens if we say add nominal rigidity down here? Well, clearly that makes the price adjust less here. It means quantities that need to adjust more, and so employment goes up by more for the factors on the left. But now what happens if you add a lot richer input-output linkages? It becomes much less obvious to see exactly what's going on. And I think this kind of a formula like the one I derived kind of gives some intuition whether it's let's see if this works. If it's these guys, if it's these workers on the left that have their employment changed by more, or if it's the workers in the middle or on the right. Now, what about deviations from Cobb-Douglas? Just to make the model a bit richer, I actually think that's totally doable. You can get a lot of tractable mileage, even if you deviate from Cobb-Douglas, precisely because we still have wages all changed by 1%. 5 minutes, thank you. What about dynamics? Even that I think you can still do. The key thing, I think, that makes our life very, very hard And the key thing that causes ELISA to have to go through so much trouble in the paper, I think, is coming in if we want to have a finite Frisch elasticity and or fixed factors or partially fixed factors in the model. And so I would appreciate, for example, if the paper went as long as it can without making that assumption to build intuition, and then at the end maybe we have to bite the bullet and actually add those features as well. Just a simple example of what comes out. This is ELISA's calibration to the US economy here. And basically what you see quite a bit of variation, pretty much what ELISA showed in Chile, across sectors. And what's kind of striking is that the sector that has the most employment response, or the factor that has the most employment response, are construction workers. Now, I would have thought that's intuitive, right? Because construction workers build houses, and houses are a form of capital. But that's not the reason why this happens here, right? This must be all about price rigidity. So that's one question for ELISA here. Is this all because somehow construction workers, in the way she calibrates the model, supply labor to sectors with sticky prices? All right. Let me go to my comments. The first comment, and it's more of a question than a comment, is what is the nature of the paper? What kind of paper does ELISA want to write at the end of the day? So a nasty referee 2 might say, isn't it obvious that greater price rigidity means a greater quantity response, right? What's sort of the, is there kind of not to shift around supply and demand curves and kind of get that? And I think that's already unfair based on what I showed you, that there's a lot of richness that comes in through the input-output network that makes this intuition far too simplistic. But there's, I think, two conceptually different routes. They're not mutually exclusive, but two conceptually different routes that I can see here. The first route is the more qualitative, insight-based route. I'm going to call this the Gali route. So here it might help to make the theory a bit more accessible, so I can read it on an afternoon and kind of understand exactly what's going on. And maybe one way to go about this is to have sort of these interpretable decompositions that I mentioned, where you can, for example, show which sector's price rigidity is exactly causing which factor's employment response. So you can exactly show, for example, why construction workers have such a strong employment response in the calibration. The second route, I think, is the more quantitative route, the CE, Smets and Routers type route. But here, I think we want more bells and whistles, right? Here, I think we want to, for example, respect the fact that in the data, it seems that inflation is very inertial. And that matters if we're talking about price rigidities. And I think here we also need a proper model of investment. What do I mean by that? Right now, the model of investment is not really a model of investment in the sense that it's a full depreciation model, and ELISA knows all of this, and there's no time lag between when you invest and when you increase a capital stock, okay? And this means the interest rate does no direct effect on how much you invest. And I think that's sort of an abstraction that we may want to relax if we want to go fully quantitative here. And there's obviously other sources of heterogeneity, depending on the economy we calibrate to, that we might want to look into. For example, for the Chilean economy, it might be useful to have an open economy aspect to it. Second comment, here, right now in the calibration at least, the price rigidity is the only game in town, right? That's kind of driving the heterogeneity. Now there's more coming in future iterations of this paper, but right now that's in there. And as ELISA mentioned, one thing that's hard to get at when we split households by occupation or specific demographics is heterogeneity in consumption baskets. And here I actually have a nice picture for you, because I have spent a few years trying to disaggregate national accounts in another country that has great data, which is Denmark. And one nice thing you can do there is you can see where people spend. And it turns out that there's a lot of heterogeneity in consumption baskets once you allow for different locations that people live in. So for example, this is Denmark. This is where Lego is located. This is where the Lego workers spend. You see that it's sort of relatively focused, on Billund, this municipality where Lego is located. If I gave you the consumption basket of, say, somebody living up here, it would be much more focused around there. So you get a lot more heterogeneity in consumption basket if you, for example, allow for a region as one of your consumer dimensions. And my last comment is on comparing Ruble 2021 to Ruble 2022. So in my simple tractable model, at some point I realized that the predictions for total employment by sector rather than employment by factor is independent of the number of factors I have in the model. And so I could collapse all factors in a single one, and I would still have non-trivial predictions for employment by sector. And so once I do that, I'm in Ruble 2021 world, and that's something I think that Elisa can talk about in future iterations of her work. She can compare the rich model that has the heterogeneity on the household side as well, and see how much, at least, of the sectoral implications carry over into a model with a single factor. With that, I'm going to conclude. I think this is a very exciting new paper, despite everything that goes into it, and it's a lot to digest, but there's very interesting implications there, and I see a very bright future for this kind of research. I offered 3 comments. First, on the nature of the paper, whether we want to go more Geordie or more Smets and Wouters. The second is on the price rigidity, and maybe we want to allow for other dimensions of heterogeneity, and the third was on relationship to her past work. Well, thank you very much again for having me.
Minutes for questions and comments. Yes, please, Sophia.
Okay, now it's working. I have a question related to what Ludwig was saying about other sources of heterogeneity. Considering the Chilean economy, you could look at informality, for example, because labor informality in Chile is quite important. It's a sector that is quite flexible. It usually doesn't use capital, so that could be important. And also, I wanted to ask you if you have considered looking at, regarding the small open economy comment of Ludwig, regarding immigration, because for some sectors that could also play a big role. Thank you.
Thank you very much. Very interesting. Yes, please.
Yeah, Jim Bullard, St. Louis Fed, very nice paper. So one of the things that's happened in the current environment is that we got a sort of global inflation shock, and then lots of prices moved very quickly. So I know this isn't part of your model, but I just thought I'd ask what you think about that, as opposed to sort of viewing these different markets as having a certain amount of sluggishness that's kind of, there permanently.
Did you hear?
So it's about state contingent pricing. So one of the things that's just happened just recently in the last 2 years is that obviously there's been a big increase in prices across the board. Should I really think of that as sticky prices? Since everyone seemed to be able to react in this environment and move their prices, fairly quickly. So I don't know, how would that attenuate your results, or would that exacerbate your results, or what would that do?
Thank you very much.
I just had a really quick question about the delta. I'm here. About your capital delta matrix. You showed us a heat map which is essentially the delta, like what the coefficients are in the delta matrix. Can you show us that matrix? Because how far away that is from 1 is obviously very important for the results. I mean, that's what Ludwig was saying. That's the key thing right now. I just wonder how robust are the results to the estimated delta matrix if you raised each of the coefficients by a little bit. How robust are the results and stuff like that?
Thank you. Yes, please.
Yeah, thanks. So I think it's super important to think about the effects that monetary policy has on different types of workers. And actually, this interacts non-trivially with Hank in the sense that in Hank models, you really want to know if the workers that have more cyclical income also have a higher or lower marginal capacities to consume. And so that's actually a relatively reduced form thing that you can do, given your model, which is measure cyclicality as given by the model and then compare that to marginal capacities to consume by sector and see whether this is something that would lead to amplification or dampening in a Hank framework. So that's one point. And then another one that relates to Ludwig's comment on heterogeneity in price rigidities is all there is at the moment. I think that there's a fact that Pete Clino pointed out to me, which is that the sectors that are more interest sensitive in the economy, like construction and so on, tend to have also more flexible prices, and also say durable goods, more sensitive. Demand is more sensitive to interest rates, but also have more flexible prices. And so I think that kind of goes against price rigidities as just the single source of heterogeneity across sectors. And so just thinking about how you can square that with the effects on interest sensitivities across sectors would be important.
Thank you very much. I think that's all. We have quite challenging comments and questions. We look forward to your answers.
Okay, so first, thank you, Ludwig, for the nice discussion. Yeah, I very much agree with you that there is a lot of theory, but also a complicated quantitative model in the paper. I mean, what I'm interested in is more the Gali route than the Smets and Wouters route, for sure. So I agree with you. I mean, I guess what I tried to do in the presentation and I'll try to do in the paper is like make the theory more accessible and like also clarify what's the value added of having this complicated model. So maybe a couple of things I can say right now. As you presented, like it was very nice, like the Cobb-Douglas model you had, and so I think that's great for intuition. I think there is a lot of value added also in abandoning Cobb-Douglas because I think it's a very realistic feature. Like energy is a very complementary good. Other types of workers might be, or goods might be more substitutable. And I think a neat implication of this kind of theories is that you have a clear concept of what's the relevant substitutability that you need to use when you're thinking about each worker, right? So I think that maybe I didn't emphasize it as much, but in microsectional multiplier, the exponential switching term is really giving you that elasticity, and I think that's a nice contribution of the theory. Yeah, I guess you also pointed out how does this relate with the Buckeye and Fari papers. Yes, it's a very similar framework with a few more bells and whistles. They have more of a technical analysis, like, okay, this is like forward propagation, like from cost to prices, backward propagation from demand to like, yeah, essentially from good demand to factor demand. I think like what they do is like, I think I have kind of a neat trick to solve the model explicitly, which they don't. And I feed different shocks, but I want to acknowledge it's their framework, so it's a, yeah. Great, so to Sophia's question, thank you for the suggestions. I very much agree that the informality dimension is something we could look into. And I agree with you, it would imply probably more flexibility in prices, but potentially also a more inelastic labor supply. I think informal worker might just disappear from the workforce easily, I don't know. And on the migration side, I'm not sure how easy it is to measure, but I very much agree it's an important component, and it would be very cool to, I think both dimensions kind of neatly can be mapped into some wage stickiness and labor supply elasticity parameter. It wouldn't fully capture all that you're saying, but I think it would be still capture some, so I think it's great. To Jim's question, so the short answer is like, it's a Calvo model with all the defects and like drawbacks of a Calvo model. So I am not going, like, I mean, the model is as good as like the estimate of the delta parameter. If you get a big shock and people wake up and suddenly delta becomes very big or very large, then the model is not going to be good anymore, right? So if everybody has delta equal to 1, then you're done. But on the brighter side, I think there is a lot that this model can tell about interpreting inflation movements. So I mean, I have another paper in like the same family, which is really using these disaggregated models to speak meaningfully of supply-side shocks and inflation. So a big drawback of like representative agent models is that, and like not just representative agent, like representative sector models, is that you don't really have a way to talk about supply side shocks and inflation. Like cost push shock is the change in desired markup, whatever it's. All right. Whereas these disaggregated models instead allow you to map some like cross-sectional changes in demand or productivity into something that affects CPI inflation. Okay. And so this is like maybe not exactly related to your point, but I think it's I think these are very interesting models in the sense that it would tell you that a shock to flexible price sectors or like capital intensive sectors, which kind of goes together with like what we see right now, like oil is very flexible, supply chain bottlenecks are like happen in somewhat like capital constrained or land constrained sectors. All those shocks through the lens of this kind of models would give you inflation. And I think another nice thing that these models produce is somehow you can use inflation data to tease apart what component of inflation comes from an aggregate shock, like monetary policy, and what components come from a cross-sectional, like demand or productivity change. And like in my calculation, I find that it's about half-half right now in the US. And I mean, you can see it because if you look at the equations I showed before, like inflation is like, you can basically boil it down to one component which comes from the aggregate output gap and the remaining things that come from cross-sectional stuff. So yeah, I think that's, and you can tease it, the model gives you a way to tease apart in the data. So. But of course, I mean, it's a linear model, so the deltas are a function of stuff, and even the phi, the elasticities of labor supply could be a function, or like even of capital supply. Like maybe capital is fairly elastic up until you hit the constraint, and then it's like very inelastic. So yeah, it's. And to also this question, I mean, of course, it's sensitive to the calibration of delta. In this calibration, it's literally the only element of heterogeneity I have. So if you kill that one, you just kill everything. But you still have input-output stuff. So even if the delta becomes uniform, like if you're in a longer production chain, then you get more of an effect. And I think that's why the construction workers seem to respond a lot, because construction is a fairly short chain. So I think that's why they're like, they end up being like, more respond more just because they have fewer accumulated rigidity. That's my best intuition for that. And so I think this is less affected by the issue of the investment or like interest sensitive goods being more cyclical, because the length of the chain is what it is. I very much agree on the interaction with Hank. It would be hard to model meaningfully, a saving decision with jointly with the real income side. Probably the things that you develop, like the Jacobian methods, would be great. But of course, it would be hard to get closed form solutions. I don't know how, even just empirically, how the predictions of the model correlate with estimates of MPCs across the income distribution. But that's definitely, I think Christina Patterson has a paper on government spending where she does something similar. But it's a different applications, and I think it would probably be a different answer to what one would get. And if you're interested in talking about it, I am very interested too. All right, so any other question? Yeah, Ernesto.
Not really a question, just trying to respond to some of the stuff. So about informality and migration, those are great comments, and I think that the bank is in a good position to answer them, at least for the open for the Chilean economy in some extent. About to Adrian, basically, it's I agree very much that heterogeneity in price rigidity is not the only thing that may matter for the aggregate propagation of sectoral shocks, but something that we learned from the input-output literature is that it's not only the characteristics of their own sectors what matters, it's also what is going on in the rest of the economy, in the way that sectors are interlinked. It would be great to have something like Ottonello Winbury interacted with input-output and sectors and all of that. Fortunately, we're not there yet, but maybe it's something we could talk over lunch. Thank you.